So guys, we are back with another round of portfolio reviews, and I am extremely excited for this one because we've got some really interesting portfolios on deck today, and we're going to go under the hood to take a look at each one. We'll check out all the holdings, and I'll give you my honest thoughts on what I like about these portfolios, as well as what I think could be improved. And as we're going through these guys, please keep in mind that I am by no means a professional. These are just my very amateur opinions, so definitely take them with a grain of salt. And remember that at the end of the day, this is all just for fun. Now, real quick before we get into it, if you want to have your portfolio reviewed by me in one of these videos, just fill out the form I have linked in the description. And also, as we're going through these, leave me a comment below and let me know what you think about these portfolios. I'd be very curious to get your feedback as well. Now, getting into our first portfolio of the day, this one belongs to my friend who we'll call MG. He wants to remain anonymous, so we'll just use his initials here. But MG has been investing for somewhere between 1 and 5 years and has a really long time horizon. He's not hoping to live off dividends for another 30 years or so. With that said, he's investing $4,000 every single month, so he's hitting those contributions extremely hard. And in the notes here, he says, I started investing when I was 20, when my grandfather passed away and left behind some money for me. I put all of that into my investments as well. I'm 22 now, which is crazy, 22 investing $4,000 every month. But he says, I'm 22, have a job, and only invest about half of my paycheck. My philosophy has always been aggressive, and I'm not a fan of ETFs, but I wouldn't mind some high dividend paying stocks. I know it's contradictory to your philosophy, but regardless, I thought I'd share my portfolio. I like to find good companies with good growth projections and just go in on them. Given I'm 22, I don't mind taking a riskier approach as I want to retire early. And I think that's fair. You know, I don't expect everyone to invest in the same exact way that I do. I'm just doing what seems to fit me the best, and everyone has their own version of that, so I'm glad that you found yours. Anyway, looking at an overview of MG's portfolio here, as we can see, it is currently valued at a whopping $349,593, almost $350K in this portfolio at 22 years old. That's just insane, and all time he's up about $88,000, so seeing some really nice profits, and just today, as I'm recording this, he's up over $4,000. I can only imagine what that's like. Now with that said, looking at the dividend stats, the starting yield is very low, only 0.28%, which makes sense if he's not a dividend-focused investor. I'd imagine a lot of these positions either don't pay a dividend, or if they do, the starting yield is going to be very low, which tends to be the case for some of these growthy companies. But anyway, the dividend growth rate is actually pretty decent, 7.4%. So some very solid numbers across the board. And as we'll see in just a moment, the holdings in this portfolio are pretty solid as well. Real quick though, I wanted to mention that MG has shared his portfolio with us here using Snowball Analytics, which is actually the sponsor of today's video. This is hands down my favorite portfolio tracker, and they're actually running a killer sale right now, so I want to tell you a little more about it. One of the most essential tools for any dividend investor is a solid portfolio tracker, and Snowball Analytics is like the Swiss Army knife of portfolio trackers. As you can see, the layout is very clean and intuitive, and the platform overall is pretty easy to navigate. Plus, it's packed with more charts and graphs than you can count, which speaks to just how much data you get, not only for your portfolio, but also at the individual stock level as well. Pretty much anything you want to know about a company's financials or dividend history can be found here within the platform. Now, in my opinion, what really sets Snowball Analytics apart are the features that it has specifically designed for dividend investors. I'm actually convinced that this platform was made for us, and here are some of my favorite features. First off, Snowball tells you your total returns by default throughout the platform, which may sound like a small thing, but it's crucial for dividend investors because it doesn't neglect the dividend income we receive when calculating returns. Most other portfolio trackers will only show your share price returns, which is really only half the equation, so it's refreshing to see dividends automatically factored into these calculations. Additionally, Snowball has a pretty in-depth event calendar that keeps you updated with upcoming news, dividend payments, and any other important stuff going on, and they even have a dedicated dividend calendar so you can see who's paying you each month, when they're paying, and how much they're paying. Beyond these tools, Snowball also has a community section where you can check out other users' public portfolios to see what others are investing in, which is always a fun thing to look at. Plus, they have stats for stocks and ETFs that show what's trending and what's popular among other investors. This makes Snowball not just a killer portfolio tracker, but also a great place for dividend investors to get new investing ideas. So overall, if you're looking for a great portfolio tracker, which really is something that every investor needs, then I highly recommend you check out Snowball Analytics, which you can actually do for free. All you need to do is click the link in the description of the video or in the pinned comment, or just scan this QR code right here to get a free 14-day trial. And if you like it, you can save 30% 30% on your subscription right now until September 24th. So time is definitely of the essence. I really love using Snowball Analytics, guys, and I know you will too. So definitely take advantage of this sale and save 30% on your subscription. All right, guys, now getting back to it, looking at how this portfolio is diversified. In total, there are 12 different holdings, 2 of which are ETFs. And in his notes, he said he's not really a big fan of ETFs, but there are 2 of them in here. So the other 10 positions are going to be stocks. And the ETFs only make up 5% of the portfolio. So the great majority of this portfolio is in individual companies. And if we scroll down, taking a look at all of the holdings, let's categorize this by largest to smallest. We can see a lot of recognizable names right here. The only one that might not be familiar is this down here, which looks like an AMD call option. So he's doing a little bit of options in the portfolio, but I would imagine most of this other stuff will recognize. And as far as the 2 ETFs go, he does have SMH, which is a semiconductor ETF, and there's also a Bitcoin ETF right here as well. So once again, these 2 make up about 5% of the portfolio. And then as far as the individual companies go, we've got Nvidia in the top spot. This makes up 27% of the portfolio, and he's seeing a really solid return with this one up 50%, which helps to explain why it's become such a large position. Then we've got Alphabet in the number 2 spot, also seeing a really solid return. This is going to make up 18% of the portfolio. We've got Amazon in 3rd place, decent return, making up 16% of the portfolio. And then we've got TSM here, which makes up 10.5% of the portfolio, and the gain with this one has been awesome, up over 50%. And actually, most of these positions, with the exception really of Bitcoin and the call option, we're seeing some profits on, some crazy profits from the likes of Lemonade, Spotify, and even Meta and Vistra Corp down here are seeing some pretty solid returns. And all in all, I think these are all pretty fine companies. You definitely can't go wrong with the likes of Nvidia and Alphabet, Amazon, Microsoft. However, on that note, I will say you have about 61% of your portfolio in the top 3 holdings here, which I think is a bold move. And I will say, I personally wouldn't feel very comfortable having so much of my portfolio concentrated in so few positions, but that's just me. And I think maybe that speaks to the differences between our approaches. And I know that in your notes, you said you have a very aggressive philosophy. But with that said, you are only 22 years old and you've really only been investing for like 2 years, during which time you've only experienced a very hot market. You have yet to experience a serious and sustained downturn in the market. And I'd be curious to know how it changes your tune if and when you do go through something like that. After you go through something like that, I think you'd be surprised at just how much it can change your appetite for risk and your want for an aggressive approach to investing. Still though, I'm looking at your portfolio here and I don't even consider it to be all that risky. The biggest risk from what I can see is just so much concentration in so few companies. But like I said, these are all really top-notch positions. And even with these 3, I think you could have picked worse ways to fill up 60% of your portfolio. All in all, MG, I think you are well on your way to early retirement. If the market keeps pumping, your portfolio is definitely going to benefit from that. But I do think if things head in the other direction, you'll definitely feel that in your portfolio and it may not feel so good. So I just think that's something you'll want to keep in the back of your mind as you continue to build this out. All right, guys, now this brings us to portfolio number 2, which belongs to my friend Aaron, who's been investing for somewhere between 1 and 5 years. So relatively new to the investing game, and he hopes to live off dividends sometime in the next 2 to 3 decades. So quite a long time horizon. And every single month he's investing $200 into his portfolio. And in the notes here he says, I'm 20 years old and started investing around January 2024. So he's about 1.5 years into it, coming up on 2 years here pretty soon. He asks, should I be attempting to buy more risky stocks or stay on my current path? We'll check that out, but I do want to say great job getting started investing so young. And the same thing with the last portfolio too. It is so awesome to see so many young people getting into investing. It's my favorite thing to see because it's such an important thing. So hats off to all of you young guys out there getting into the market. And if we look into Aaron's portfolio here, he's also shared it with us using Snowball Analytics, and we can see it's currently valued at $16,383. So a nice chunk of change. And all time, he's up 13.6%, almost up $2,000 in gains. So great job there. And as far as the dividend stats go, we got a low starting yield here at 1.9% and a dividend growth rate of about 7%. Now, scrolling down a little bit, looking at the diversification, in this portfolio, there are 13 holdings in total, 7 of which are individual companies, with the remaining 6 being ETFs right here, which we'll talk about. But as far as the makeup goes, it looks like about 55% of the portfolio is in ETFs, with the remaining 45% being in individual stocks. So pretty well balanced diversification there, I will say. And if we scroll down looking at all of the holdings here, let's categorize this by heaviest weighting. Looks like in the top spot, we have the S&P 500 500, making up 17% of the portfolio. In the number 2 spot, we have ASML, great company, coming in at 16%. We have SCHG, making up 13%, nice growth ETF. SCHD at about 12.25%. And then it looks like we've got a few individual companies here, Vici, Johnson & Johnson, and Equifax, all great companies. And then it looks like we've got a Schwab Total Market Index mutual fund right here, making up 6%. And then we've got a JP Morgan growth fund, a couple more companies. We've got Centene and Pepsi. And then we've got another ETF, actually, Schwab US Large Cap ETF, SCHX. Very small position, less than 1% of the portfolio. And also Coca-Cola, only one share at 0.4% of the portfolio. So another small position to close it out. Now, right off the bat, I like all of these holdings. I don't think any of these look sketchy at all. And I do like, most of your portfolio being in ETFs. I think for a newer investor, that's a good place to go. But with that said, the big thing that jumps out to me about this portfolio is I just think you have too many different ETFs and mutual funds, too many funds going on here. Scrolling back up a little bit, these are all of the different funds in the portfolio. So once again, in total, there are 6 different funds. And truth be told, I think you're fine just with these top 3, the S&P 500, SCHG, and SCHD. There's really not going to be a whole lot of overlap between the S&P and SCHD. And there will be moderate overlap between SCHG and the S&P 500, but I don't think it's so much that you can't have both in your portfolio. So I definitely think there's room to own these 3. But with that said, I do think that you can ditch the rest of these funds right here. Other than that, Aaron, I think this is a really solid looking portfolio. I think if you just stay on this path, you'll be in pretty good shape. And you did ask about potentially buying more risky stocks. And in my opinion, I don't think you need to go out of your way to do that. If you want more exposure to more growth-oriented assets, I think it'd be fine just to allocate more of your contributions to things like the S&P 500 and also to SCHG. Otherwise, I think you're good to just keep on keeping on. This is a really solid spread you got here, so keep up the good work. All right, guys, now moving on to portfolio number 3. This one belongs to my friend Isaac, who's relatively new to the investing game. It says he's been going at it for somewhere between 1 and 5 years, and he has a pretty long time horizon, hoping to live off dividends sometime in the next 2 to 3 decades. And he's doing really well with his contributions, throwing in $500 every single month. And in his notes here, he says, I just turned 25 years old. I wasn't taking as many risks as I could when I was younger. I come from a more conservative family when it comes to taking risks. Less than a year ago, I started building my foundation in stocks and funds, and I hope to buy a house in 10 to 15 years. Now, taking a look at Isaac's portfolio here, 25 years old, he has about $34,000 invested. That is awesome. And he's up about 4%, so he's seeing about $1,500 in gains. And looking at the dividend stats, he's rocking a 1.1% yield, so a decently low starting yield and a 6.3% dividend growth rate. Now, with that said, if we scroll down looking at the diversification, it's a bit interesting because we can see the great majority of this portfolio is in cash. About 63% of it is in cash right here, which I don't think we've ever seen that in one of these portfolio reviews before. But then besides the cash, there are no ETFs in this portfolio. There are only individual stocks, of which there are 10. And if we scroll down looking at all of the holdings right here, let's reorganize it from top to bottom. These are all going to be very recognizable names. Tesla's the largest position at 7.3%. Nvidia's at 6.2%. And if we just go down the list here, like I said, we'll recognize all of these companies, all very solid companies right here. Not only that, but I think there's a pretty good balance here between more growthy stocks and more dividend stocks or dividend growth stocks. Companies like Tesla, Nvidia, Amazon, these definitely fall in the growth categories, but some of these can also double dip into the dividend growth side of things, like Alphabet and Microsoft and Apple for sure. And we've also got Chevron and Johnson & Johnson and Procter & Gamble on the dividend side of things, not to mention Visa, great dividend growth stock. And with all of that said, the only thing that kind of leaves me scratching my head with this portfolio is why so much cash in this portfolio? You're 25 years old. You have a long time horizon. I think all of that cash would be better just put into the market. The only thing I could think of is maybe this is the cash that he'll be saving for the down payment on his house. But once again, he said that's 10 to 15 years away, which is a really long time. Nonetheless, the amount that you do have invested looks pretty solid. They're all solid companies. I think it's pretty well spread out across all of those different positions. So I have nothing bad to say about the amount of funds that you do have invested. So keep up the great work there. But anyway, guys, those were our 3 portfolio reviews of the day. And if you want to see more portfolio reviews, then check out this next video right over here. In this one, we'll look at 3 more subscriber portfolios, one of which is actually sitting at almost $500,000, and the investor it belongs to is only 38 years old, which is impressive. So click right over here to check that out, and I'll see you in the next one.